Ever thought about why you're sprinting on a treadmill that keeps getting faster? Most of us think money is the trophy for our hard work, but that's the first lie they fed you. In his book Debt, The First 5,000 Years, David Graeber argues that money isn't some evolved form of barter. It's literally just a ledger of what is owed. It's a social obligation, not a physical object. If you don't grasp this, you're paying an invisible tax that sucks away about 30% of your lifetime earning power through interest and inflation. We're living in a debt-based reality where the global debt-to-GDP ratio has exploded, hitting a record $307 trillion, according to the 2023 Institute of International Finance Global Debt Monitor. That's nearly $40,000 for every human on Earth, most of whom will never see a fraction of that in their bank accounts. If you don't understand that your dollars are just government IOUs circulating in a system designed to devalue them, you're basically a volunteer in a financial labor camp. Stay tuned, or keep donating your life to a spreadsheet that doesn't care if you retire. Seriously, it is time to wake up and smell the inflation.
Look, your grandma's advice about saving for a rainy day is officially a recipe for poverty in a fiat system. The logic is simple. While you're dutifully tucking away paper under your mattress, the system is busy printing more of it, making your pile worth less every second. It's what I call the saver's trap. The Federal Reserve Economic Data, FRED, on the purchasing power of the consumer dollar shows a depressing inverse correlation. As total debt rises, the value of your saved dollar falls off a cliff. This isn't an accident, it's by design. We've been psychologically conditioned through the democratization of credit cards since the 1950s to view high-interest liabilities as lifestyle upgrades. Take the infamous 1990s case of the Japanese lost decade, where savers were absolutely crushed by deflationary debt traps. Dr. Lacey Hunt, a renowned economist, points out that once debt levels reach a certain threshold, they actually stifle growth and destroy the middle class's ability to accumulate real wealth. You aren't building a nest egg, you're just holding a melting block of ice in a global warming economy while the central banks laugh. It's a joke, and you're the punchline.
The funny thing is, most people still think banks take your deposits and lend them to your neighbor. That's adorable, but completely false. The real pivot happened in 1971 with the Nixon shock, which severed the dollar's link to gold and turned every buck into a pure debt obligation. Ever heard of fractional reserve banking? It's essentially a legal magic trick. According to a 2014 Bank of England quarterly bulletin titled Money Creation in the Modern Economy, commercial banks don't act as intermediaries. They literally create money out of thin air the moment they approve a loan. When you sign for that shiny new car, the bank doesn't move money from a vault. It types numbers into a screen, and poof, new currency enters the system. This means the money in your pocket is actually a byproduct of someone else's debt. It's a systemic siphon that ensures the supply of money is always tied to an interest-bearing burden. If nobody borrowed, there would be no money, which is a pretty spicy way to run a civilization, don't you think? You're participating in a game where the house creates the chips out of vapor and then charges you real labor to pay them back. It's genius, really.
Let's get surgical with the numbers, because the math doesn't lie, even if your banker does. The interest amortization trap is the ultimate legal scam. If you look at a standard 30-year, 7% fixed-rate mortgage amortization schedule, the reality is brutal. In the first 5 years, roughly 80% of your monthly payments go straight to interest, not the principal. You're basically paying for the bank's vacation, while you barely own the front door of your house. Meanwhile, the big boys are playing a completely different game called corporate arbitrage. According to 2023 S&P Global Market Intelligence data, S&P 500 companies have spent trillions on share buybacks, often funded by cheap debt at low interest rates, to artificially inflate stock prices. They use debt to get richer, while you use expensive debt, like credit cards with 20% plus APR, to buy depreciating junk. The system is rigged so that the public stays stuck in high-interest consumer traps, while corporations leverage low-interest institutional debt to capture the equity. It's a lopsided math equation where your ignorance is their profit margin, and they are winning by a landslide. You're fighting with a plastic fork, while they have a chainsaw.
Think of debt as a temporal energy transfer. You're essentially hopping into a time machine to borrow your future self's labor from 5 or 10 years away, just so you can buy a flat-screen TV today. The logic is cynical. You're trading your most limited resource, time, for a liability. But wait, it gets messier. The ultra-wealthy have a loophole they call buy, borrow, die, and it's perfectly legal under current Internal Revenue Code sections. As detailed in the ProPublica Secret IRS Files report, the top 0.1% take massive loans against their stock portfolios instead of selling assets. Because loans aren't considered taxable income under Section 61, they live tax-free on millions while their assets continue to grow. They turn debt into a tax-shielding superpower while you're stuck paying 30% in income tax before you even see your paycheck. The St. Louis Fed's OASITY of M2 money supply charts show that while the rich circulate debt to multiply their wealth, the average person's debt just sits there, bleeding them dry. You're being sold the idea of credit as freedom when it's actually a sophisticated leash that ties you to a desk until you're 65. It's the most successful form of slavery ever invented.
Here's the unexpected twist that will probably keep you up at night: the paradox of thrift. If every individual, corporation, and government on the planet decided to be responsible and pay off all their debt tomorrow, the global money supply would effectively vanish. A study published in the Journal of Post-Keynesian Economics explains that because our money is literally birthed through debt issuance, a debt-free world is a world with no currency. We'd face a total civilizational collapse, a deflationary debt spiral that would make the Great Depression look like a summer camp. This means the system requires you to stay in debt for it to function. It's a parasite that has become the host. The 1% know this, which is why they don't fear debt. They manage it. While the 99% are shamed for having a balance, the financial elite understand that debt is the literal oxygen of the modern economy. Research from the Levy Economics Institute suggests that without continuous credit expansion, our current infrastructure of trade and production would simply seize up. You're not just a borrower. You're a necessary component in a machine that would explode if it ever stopped growing. Paying off the national debt is a mathematical suicide mission.
So let's flip the script and use some deductive logic to escape this mess. If the currency is guaranteed to lose value and the system is fueled by debt, then holding degenerative debt on depreciating assets is a death sentence. But generative debt is a golden ticket. Think about it. When you have a fixed-rate mortgage on a cash-flowing property, inflation is actually your best friend. A comparison between the Case-Shiller Home Price Index and the Consumer Price Index, CPI, over the last few decades shows that while inflation erodes the real value of the money you owe the bank, it simultaneously pushes up the nominal value of your asset. In plain English, the bank is effectively paying for your house because the dollars you pay them back with are worth way less than the ones you borrowed. The 1% don't try to get out of debt, they try to get into the right kind of debt. They transition from being consumers of high-interest garbage to managers of low-interest leverage. You need to stop viewing debt as a moral failing and start seeing it as a financial tool. If the system is going to print money into oblivion anyway, you might as well be the one holding the assets that benefit from it. Stop playing by the rules of people who want you to lose.
It's time for a brutal debt audit protocol, because the status quo is a slow-motion train wreck. Stop obsessing over the total balance and start looking at the cost of carry and the opportunity cost. If you're paying off a 3% mortgage while the S&P 500 has a 100-year average annual return of roughly 10%, according to standard market data, you're actually losing money by being debt-free. You're falling for the psychological trap of security, while the math screams at you to invest the difference. We have a mandate to move from the 99% who are products of the debt system to the 1% who use it as a surgical tool. Look at the historical evidence from the 1944 Bretton Woods Agreement to today. The rules are written by those who control the ledger, not those who work for the currency. Your call to action isn't just to save more, it's to radically reallocate your liabilities. Use the math, not your emotions. If your debt isn't buying you an asset that outpaces inflation, you're just a sophisticated sharecropper in a digital feudal system. Debate the numbers, check the historical data, and decide if you want to be the one holding the leash or the one wearing it. The choice is yours, but the clock is definitely ticking. Go do the math before the math does you.